Well, hello again, everyone. As we turn here to 2025, we thought it would be a good idea to welcome back our colleague, Steve Hanley from Evergreen Wealth Management. Many of you know him, but for those that don't, he is the lead portfolio manager. And so we wanted to ask him a few questions and just kind of get his thoughts. And Steve, I guess I'll start here. I guess we're at with 2024 ending. That's two consecutive years with the S&P over 20%. Um, Setting aside some of the big news stories, what's your assessment of the market as we sit here in January of 25?
Yeah, it's a good question. Obviously, without a crystal ball here, I'm not making any short-term predictions. But if we look back, if we take a step and look back at what happened, 2022 was a terrible year for the markets. So we had tremendous inflation. We had a really big decline in the S&P 500 and all the markets. And a lot of 23 was simply getting back and rebounding from that pretty large decline. And we also had, I mean, it got a little choppy in 2022, but there were a lot of areas that had experienced recession, industry specific, in the economy. And so there was a lot of recovery happening in 2023. 2024 was definitely more of a move forward year where we saw the accounts, not only now that they had fully recovered, and now we really got to move forward into some really good territory. And so that leaves us now looking at 2025. And our assessment is, the market is definitely not cheap like it was in 2015. But we're certainly looking at all these things. It's not in a bubble territory either. Always you can find certain parts and segments of the market that are massively overvalued and kind of silly. But our assessment, the big companies, a lot of what makes up the S&P 500, is in a reasonable valuation territory. And so we're kind of in an in-between. At this point, we think there could be reasonable returns over the next 10 years. But at the same time, things aren't as slam dunk as they were before in the bottom of 2022. And so we would be completely satisfied at this moment if we saw a little bit of a pause and just let valuations and earnings keep climbing and kind of catch up to make things a little juicier going forward. Or if we had a little pullback, that wouldn't surprise us either. So, you never know what's going to happen. I think if you're a long-term investor, there's going to be opportunity out there presented this year through volatility. And if we look out 10 years, we still think it's a reasonable return expectation. So
That's good. Appreciate your insight there. And just like in 2020, we're now experiencing another change election. And I thought it was interesting. We went back to some of the articles that we had written at that point. I wanted to pull out one little section here, and it says elections have many consequences. In the long term, they can and will shape many areas of our economy and life. However, usually it takes time for policies to be enacted and to work through the system. As this occurs, the companies we invest in will adjust and will also adjust portfolios as needed. We're constantly looking at how new information may affect the companies we own and are always ready to adjust as needed to ensure your investments are aligned properly with your long-term planning needs. So as we are looking to a new administration coming here later in January, and you think about those words, Steve, if you were writing another article today and thinking about some of the narratives that have been in the headlines, would your assessment change at all?
no, it's very difficult to predict the market with any kind of precision with all the variables that are out there. And the election is just one more variable. And we prefer not to get into predicting the market because there's so many sentiments, there's so much emotion, there's so many narratives at any given point around things, the election being a big one. But what really matters is what are the details going to be 5 years from now, 10 years from now, to what we said there, and the point being that, elections, things that come out can have dramatic effects in the short term. But what we're really concerned about is how do they affect the companies we own? how do they intersect with the earnings and the cash flow and the earnings and the cash flow growth of companies we own over the next 10 years? And so until we see the actual details of any changes that take place, and until we see those play out, we really don't have any good foundation or fundamental information to make decisions on. And so we have to be really careful as investors in getting caught up in the noise of all of these variables, the election being one of them, and make decisions on noise, not on fundamentals. And so we really want to parse those out and take our time, digest the information, find out exactly what are the details going to be, and then look at the companies we own and see if there is opportunity being created to own companies, or if we need to trim anything or sell anything because of the effects these details may have. And certainly that's what we're doing and will do, and will continue to do as we see actual details come out with policy changes, rule changes, and so forth over the next year. So.
That's great, Steve. Always talking to you just gives me comfort, and you're kind of a steady hand that some of this stuff transcends the headlines, in terms of looking at cash flows, looking at balance sheets, and being attracted to companies that do have stronger cash positions, for instance. So I guess as we wrap up here, is there any final or kind of parting words as people are looking or reviewing their plans here at the beginning of the year, as a lot of people do?
Yeah, I mean, the old-fashioned advice is always good. It's been there for a long time for good reason, and that's to stay long-term focused, to stick with your risk parameters, because we will have volatility. We haven't seen a lot of volatility in the last year or 2 years. We are going to have some of that creep back in, and when we do see those declines in the market, whether they're 10% or 20%, like whatever they end up being, like we have a plan for a reason. It is much easier for us to look at these companies as actual ownership rather than just pieces of paper. We can't predict what the market's going to do in the next 12 months or even the next 2, 3 years. But what we can do is own really good companies that have really good cash flow. And we're a lot better at predicting what is this company's earnings per share going to look like 5, 10 years from now. Those we've been pretty accurate with. And the same with the market. What is the S&P 500 earnings per share going to look like 5, 10 years from now? We can get a lot better idea around that. And then we can start to get a better idea of what that means for portfolios 10 years out. But over the next year, it's just a really difficult thing. So we want to see, own companies that can adjust, own companies that are really solid, that regardless of what changes, these companies will make adjustments, right? We want to own a whole bunch of those type of companies so that no matter what the rules change to, these companies are going to make adjustments. And then we want clients in the financial plan to stay the course, because we know these companies are making changes. We own these companies, and we have a really good idea of what they're going to look like 5 and 10 years from now. And if they go off track, of course, we are always looking at them, and we will reshuffle accordingly to make sure it matches the long-term planning dynamics. So that's kind of the way we look at it, but we do expect a little more volatility, but we're actually in many ways preparing for it. And if that happens, we'll hopefully seize the opportunity. So.
Excellent. Well, thanks again for your time, Steve, and we'll look forward to talking to you again in the near future. And Happy New Year, everybody, and happy investing.
Yeah, thank you, Dave.